Jess, I have to ask, how do people actually decide what stocks to buy? Like, there are thousands out there. Do people just guess? Are they just hearing a hot tip from somebody?
Oh, well, people do that, but you shouldn't. So
Right.
you're not alone there, Jessie. A lot of people do start by chasing hype or stock tips, but smart investors, they work backwards. That's what top-down investing is all about.
Oh, top down. Is that like investing from a ladder?
Not quite, but I like the visual there. Top-down means you start by looking at the big picture, kind of like a funnel. What's happening in the economy? Are prices rising? Are rates falling? Then you zoom in one layer at a time.
Okay, so you're kind of connecting the dots. Like, people are spending more, which means this sector might do well, and this company is in that sector.
Exactly. Top-down approach. Instead of randomly picking a stock, you're building a case. You're starting from real-world trends and working your way down to the companies that are most likely to benefit given the current environment.
Okay, so this just isn't for the pros.
No, not at all. This episode is your beginner-friendly guide to top-down investing. We're going to walk through how to figure out where we are in the economic cycle, what sectors do well in different environments, and how to go from big picture to smart, informed investing decisions. Another puzzle piece, if you will.
You know, I love those puzzle pieces. Okay, I'm in because I really want to learn how to invest based on what's actually happening and not just what's trending or what someone says we should be investing in. Like, we need to do this research ourselves.
Oh, yes. So stay with us. By the end of this episode, you'll not only understand how the stock market fits together, you'll be ready to use the top-down approach for your own portfolio.
Let's take this top down. I don't know. Nothing. Cut that out. You're listening to MakeHer, the self-directed investing education podcast that breaks down how the stock market works in a way that actually makes sense from her perspective.
That's us. We're her. That just means from her perspective, all are welcome. And our analytics say that all are here. So this podcast is teacher-learner style. I'm Jess Inskip. I act as a teacher. I worked in the self-directed investing space for way too long and talk markets on CNBC, Fox Business, Yahoo Finance, the Schwab Network, and Bloomberg, and recently Cheddar.
Yeah, what is Cheddar? Tell the folks at home.
Cheddar TV. It's another one like Yahoo Finance.
Oh, cool.
And they did great. They promoted the podcast and did a collab on our Instagram.
Nice.
Yeah.
And can we check that out on their website?
You can, or on YouTube as well.
Cool.
Mm-hmm.
I'm gonna check it out. That's not a plug. I just literally didn't know.
Oh, well, I did a Fed deep dive actually with them, and it's a good 20 minutes. I'll probably send it out on the newsletter.
Oh, yeah.
That I haven't the past 2 weeks. I'm sorry. I was busy.
Yeah. It's been a while since we got to talk and you can't tell. And I'm Jessie DeNuit. My job is to make sure that everything actually does make sense, which means I'm not afraid to ask all the questions that you're all probably thinking and that I'm blurting out.
Yes. Yes. And we love you for it. And together, we're on a mission to make you fin-fluent, not fin-fluenced. Get it?
Okay, so what all's on the agenda for today?
So here is what we've got lined up. First, we'll define what top-down investing actually is, because the name makes it sound complicated, but it's really not. It's really in the name. Then we'll walk through how to read the overall economy. We'll break down the major clues investors use to figure out what's going on in the big picture, how to pay attention. Next, we'll talk about the sectors, what they are, why they matter, and how different sectors respond to what's happening in the economy. And finally, we'll zoom in on individual companies and explain how to go from understanding a sector to choosing a stock or sticking with a simple ETF if that makes you more comfortable. So by the end of this episode, you'll know how to use the top-down approach to build smarter investing decisions based on logic, not just vibes or something you saw on TikTok or a finance bro.
The reels, not just the feels.
Oh, I like that.
That was you. You said that one. Hard data versus soft data. Okay.
Yeah, but you did the correlation.
That's right.
All right.
I'm learning. My first question for you is then, what is top-down investing?
Okay. Start the basics because the phrase sounds way more complicated than it actually is. Top-down investing just means you start with the big picture and then you zoom in.
Oh.
Think of it. Yeah.
Like reverse engineering something.
Yes. Yeah. Yeah. We don't want to start with the company. We want to understand the environment. So think of it like planning a vacation. You don't book a hotel randomly. You decide where in the world you want to go first. Then maybe you pick the city, then the neighborhood, then the specific place to stay. That's top down. You consider the environment. Investing works the same way. You start by asking what's going on in the world or the economy. Then what industries or type of businesses might do well right now given the current environment. And finally, which specific companies are the strongest in that group. Funnel approach.
Nice. No, I love this analogy because I love traveling and I love planning travel. And I think just instead of picking a stock, like we said, because someone on TikTok said so, or someone you work with, who knows, wherever, your parents, someone in your family says it's about to pop or it's something you should buy, you're instead working backwards to see what's happening from the real world and kind of validating that thesis.
Yeah,
like in a way, we can go back to our investing thesis.
Exactly. You're not guessing, you're connecting the dots. If the economy is growing and people are spending more, you might look at companies that sell fun stuff like travel, entertainment, or tech gadgets. But if things are slowing down, maybe people are cutting back and you focus on companies that sell essentials like groceries or toothpaste. But we have to know the current environment before we make that decision.
Yeah, that makes a lot of sense. And we did talk about this in the sectors episode too. If you need a refresher, I think the sectors episode's a good one to kind of,
It is.
Yeah, get this in mind. So if there's a top down, is there a bottoms up?
There is. The opposite of top down is called bottom up investing. Makes me think bottoms up. I don't know if my millennial showing. That's when you start with the company. So maybe you love their product or saw their earnings and then look at everything else later, which both ways work. You could do that too if you want to see why everybody's investing in Nvidia, that's starting with it, but you still need to consider the current environment. But top-down helps you make sense of why certain parts of the markets are doing better than others.
Okay.
Important.
Then I guess it's like, I think we compare this to a weather report, but this is like a macro weather report.
Yeah, macro weather report.
Yeah.
Macro means broad market. So top down is your investing weather report before you pick your outfit, aka your stocks. You check the weather.
Yes.
No one wears sandals in a snowstorm unless you're from Florida.
True.
Yeah. But if you're buying a stock or an ETF, you need to be able to explain why you think it's a good investment. This is the framework to do that. It is so important to be able to say why you think you should be able to buy this stock or why you think it's a good investment.
Okay. So to sum that little part of it up, top-down investing is like zooming out on Google Maps before you zoom in on where to go. You start big, what's going on in the economy, then get more specific, like picking the right area of the market, then the companies that live there. And when you do it right, you're not guessing, you're matching your investments to what's actually happening in the world. And even though we're using real data, it's still kind of a vibe.
Oh, yeah, absolutely. All right. So now that we know top-down investing starts big and zooms in, let's talk about how you actually figure out what's going on in the big picture, the macro view, if you will. This part can sound intimidating, but it's really just paying attention to the right clues and where to look at your brokerage firm. So think of the economy like a vibe check, I guess. You want to know if the economy is growing or shrinking, expanding, contracting.
Okay, so this is where the business cycle comes in, right? Because we want to know if we're expanding or contracting, like you said. So we, as in the economy, or the economy is in its follicular or luteal phase. If you know, you know. If you don't know, then watch our business cycle episode.
Yes, exactly. That's a favorite analogy. It really is. We want to gather some context clues to give us an idea of where we are in the cycle. That's what we're doing. Gather some data, if you will. Next, I'll ask, are people spending money or holding back?
Oh, like, are people saving? Like, because they're scared of a recession. So is it easy to get a job? Those types of factors?
Yeah, exactly. The stock market's centered around the consumer. We said that on our Understanding the Stock Market episode, and we talk about the consumer a lot. We're looking at the consumer's environment and their habits in said environment. So next we need to ask, are prices going up fast or staying steady?
Okay. Now I can tell that question has to do with inflation. But I noticed you said staying steady. So you mean anchoring inflation, right? I think we just talked about that on one of the Fed deep dives. Like it's not out of control. Inflation is tame. Prices are not going too far too fast. So there's an anchor.
Yes, that is exactly what we are assessing. Then the follow-up question we need to ask is, borrowing money expensive or cheap?
Which is where interest rates come in?
Exactly. Really, we're just trying to understand the current environment. We are trying to get a feel for if there is a storm brewing or if it's all sunshine and rainbows. And then we can figure out what companies fit the current macro environment. So, i.e., like literally the weather. Successful investing, it's not about buying stocks blindly. It's about understanding the current environment and then defining what and why would be more likely to thrive in that environment. These questions, they'll help you figure out what kind of companies might do well right now. That's top down. This is the way to assess it.
Okay, but like, how do people know if the economy is growing or not? I assume that is where our economic indicators come in, right?
Yeah, exactly. And those are just the regular reports that come out. We talk about them a lot, like a monthly progress report for the economy. Let's go through a few actually that will talk about that.
Yeah.
So GDP, gross domestic products. This is like the economy's report card. It tells you how much money the whole country is making. If GDP is going up, it usually means business is good and people are spending. If it's shrinking, that can be a warning sign. When we have a strong economy, we generally have growing GDP. So that's the metric we'd use for, is the economy expanding or contracting? It's one indication.
And you can find that is that on the fed.gov site, the Fed one?
Yep, you can find it there. And you also could find it if you go on your brokerage firm's website. Normally there is a research U.S. markets or research markets. When you're doing top-down investing, start there because that's going to give you the overall macro view. And usually there's economic data in there as well.
Oh, cool.
And if there isn't, find another brokerage firm. Say that so many times. So next we want to look at interest rates. This is what it costs to borrow money when interest rates are high. It's more expensive to take out a loan or use a credit card. So people and businesses, they usually spend less. And when rates are low, it's easier to borrow and spend. We have a whole episode on understanding the credit market. But generally, I want to know if we are in a restrictive interest rate environment or not.
And restrictive means that the Fed is raising rates to tackle inflation, which really means that they are trying to slow down the economy because by raising rates, it raises the cost for you and I to borrow, and businesses too. It raises the rates for all of us to borrow. So credit cards, mortgages, loans, all of it gets expensive in a restrictive Fed environment.
Yes, and the Fed is normally restrictive due to rising inflation, price stability overall, which is where we need to check next. Inflation. So CPI, PPI, PCE. We even have an episode explaining the difference of those three. Oh, that rhymed. This is how. But it tells us how fast prices are rising. A little inflation is absolutely normal and healthy. That's why we want it anchored to 2%. But when prices rise too fast, too far too fast, anything that moves too far too fast is bad. It can hurt how much people can afford to buy. Certain types of companies do better in high inflation, like energy or companies that can raise prices easily. Others do not. And then next, we want to understand the unemployment rate.
The dual mandate.
This is very important. Yeah, this is basically checking the dual mandate. Like how is the cushion, which is the economy, is it healthy, is it strong? And then maximum employment and price stability. So on to the maximum employment, we look at the U rate or the unemployment rate. Are people working? If a lot of people have jobs, that's a sign that the economy is doing well. If unemployment is high, that usually means a slowdown. And employment is such an important component. If people have jobs, they have money. And if they have money, they tend to spend it. The real question we're trying to figure out is, where are people or businesses going to spend said money?
It's like reading the economic tea leaves, if you will.
Oh, yes. Investors, we read these like clues, try to interpret the data, literally. And don't just look at one. Look at them all together, the totality of the data, in the words of Papa Powell, to get the full picture. It is like checking the weather app, though. Like, look at the pollen count, where it says feels like, but actually is.
Yeah.
And then the forecast for the next couple days. You're planning your outfit, literally. But the more you know, the better decisions you make. And the most important part is when you understand this, you can start making investing decisions based on facts, not fear or fear of missing out on some type of trade. We're assessing the current situation, and that's so, so important.
Yeah, no using FOMO when buying, investing securities
Agreed.
in your portfolio. Okay, so here's what I'm taking away so far. Top-down investors don't just pick stocks. They start by understanding what's happening in the overall economy. They look at real-world data like how fast the economy is growing, whether people have jobs, how expensive is it to borrow money, and how fast prices are rising, inflation. So these are all called economic indicators, and they help paint a very clear picture of where we are in the cycle, the business cycle. So once you know all of that, you can figure out which parts of the market are likely to benefit, and that makes your investment decisions more strategic, not just emotional or reactive. So the big lesson here is the more you understand the world around you, the better of an investor you become.
Yes. All right. So we've zoomed out, looked at the overall economy. We've talked about how you can use real clues like GDP, inflation, and interest rates and jobs to understand what's going on. You should understand if you're expecting volatility and need to add some defense to your portfolio. Does that count as a sports analogy?
Oh, well, I guess.
Fine. All right.
But we could say self-defense, martial arts. I don't know. We'll let one slide.
Yeah. Or if you're not defensive, you're deciding if you're optimistic and you want some growth opportunities. But we're not done yet. Let's talk about the middle layer, the connector between the economy and individual companies, and that's sectors.
Yes. And like I said, we did a whole episode on those. The GICS sectors, right? There's 11 of them, and maybe we should just describe it real quick for our lovely listeners. Stocks are categorized into sectors and industries.
Yes. And we say GICS sectors.
Oh, GICS. Yeah. I was like,
GICS.
Is it an acronym?
It is. Yes. What it stands for off the top of my head, don't know.
Okay, yeah. I was
but
like,
I know it's
I
a
do not remember that
classification.
one. Pop quiz. Oh, no, I fail. I'm glad we both don't know.
Well, you know what? We couldn't tell you what the acronym stands for, but we could tell you what it is. It's the classification of the 11 sectors.
Oh, yeah. The way they're classified. Someone came up with the classification. Yeah. Yes. Okay.
Yes. So a sector is just a group of companies that all do similar things. Think of it like an industry category. So in the U.S., there are 11 major GICS sectors that make up the stock market. These are standardized, meaning they're used across all investing platforms, and each sector behaves differently depending on what's happening in the economy. So on your brokerage firm's website, look for the tab that says sectors, and you will find so much information. So you can go research markets, find out what's happening, go to the economic data, you'll get a pulse of the economy. Now we're going into sectors, and it should be on that same page, or there's another tab.
Okay, cool. Good to know where to find it. So it's kind of like you're grouping your closet by type of clothing, like all the jackets go together, all the shoes in one spot.
Yeah, actually, it's a good analogy because if we're going with that weather one, like maybe you need your raincoat, like these, and people who live in places with actual seasons have winter boxes and stuff.
Yeah, like me.
That work at different time frames.
I just put my winter clothes away, and now I'm going through summer clothes. And that can be the defensive part, like bringing an umbrella.
Yeah, Absolutely. Or we could, use a Taylor Swift analogy. It's like each era. It's categorization that kind of goes together. It fits, if you will.
It's been a while since you threw one of those in there.
I know. My boss has been giving me Taylor Swift quotes, and I think that's how I've been getting my Taylor Swift fix.
Back on the brain.
It's been happening. Like literally on my review. Anyways, I'm not going to.
Oh, yeah. No, that's great.
I know.
Speaking your language, great boss.
It is. It's fantastic. So these are the 11 sectors. Information technology, healthcare, energy, financials, consumer discretionary. Those are our wants. Industrials, energy, communication services, utilities, real estate, and consumer staples. Consumer staples are our needs. Each one of these sectors, and this is what we go into in our sector investing episode. Each one reacts differently to different economic conditions. This is a key to top-down investing. Once you understand the economy's direction, you can figure out which sectors are most likely to benefit.
So if we think that the business cycle is expanding, the economy looks robust, then what sector or sectors would we look at?
So let's say the economy is in recovery mode then. Expanding. People are going back to work, spending a little more, rates are low. In that case, we'd look at sectors like technology, information technology, because people are spending on it, consumer discretionary, those are our wants, and industrials, because people are building things. They tend to perform well. Why? Because they rely on people spending money, borrowing money, and making business investments.
Yeah, that makes sense. So what do we think if the weather forecast says potential recession? Then what?
So if the economy's slowing down, we already would know this from looking at the economic data. People are holding back. Layoffs are rising. Unemployment might be going up. Rates are high. You'll usually see strength in sectors like healthcare, utilities. People have to pay their light bills. People still need healthcare, and consumer staples, think toilet paper, groceries, etc. Those are the companies we rely on no matter what, whether times are good or bad.
Yeah, and some sectors are kind of like essentials and others are kind of like nice to haves.
Yeah, exactly. Investors call those defensive, hence why we had to have the sports analogy, because it's just the classification of it. But it's defensive versus cyclical. So if you ever hear on finance media saying, oh, we're getting into cyclicals, we favor cyclicals right now, or we're getting into defensive, that means defensive sectors are stable during rough times and cyclical sectors do better when the economy is booming. And I know this podcast mainly is focused on the US right now, but that's where most of our listeners are investing. But this framework right here works absolutely anywhere. Investors around the world use top-down strategies to analyze economies and sectors globally, but the principles are the same.
Oh, yeah, that totally makes sense. And when we understand how sectors respond to different parts of the economic cycle, then we can invest with strategy and not just, throwing spaghetti at the wall to see if it sticks or whatever.
Yeah, exactly. So some examples, if you think interest rates are going to fall and the economy will pick up, tech and consumer discretionary stocks might be attractive. They're looking good. If you're worried about slowdown, healthcare or utilities might be a safer place. And you don't even have to pick individual companies. Like, this is where I love the top-down approach, because it also goes with the framework of your portfolio. If while you're understanding the market, do something passive, we say, then you can get a little tactical with sector investing, because there's an ETF for that. So you can invest in just sector ETFs that give you broad exposure to the whole group. You don't even have to choose a company at this point.
I mean, wouldn't it make sense for long-term investing to be invested in all the sectors?
I mean, you are when you're invested in the S&P 500.
Oh, all 11 sectors are in there?
Yes,
cool.
They are.
Good to know.
Yeah, and then there's weightings. We should talk about that. But then what would happen is you have market weight, and then you'll see analysts say they're underweight or they're overweight or they're market weight. And if you're a little more aggressive, you could say, or you think the economy is expanding, I want to be overweight information technology. That just means you have a little more exposure to that.
Yeah.
And you could do that by buying an information technology ETF.
That makes sense. Okay, well, this actually helps a lot, because before we started this podcast, I just saw the stock market as a giant pile of companies, and I didn't realize that it's actually organized and that those groups respond to the economy in a very logical way, often, I'd say.
Oh, yeah. Facts. 90 plus episodes, and look at you now.
Yes.
I love it.
Investor extraordinaire. Well, not quite, but we're getting there. Okay, so here's what we just learned. Sectors are like the bridge between the economy and companies inside your portfolio. There are 11 official sectors in the US, and each one responds differently depending on what's going on, like whether prices are rising, rates are high, or people are spending money. Understanding these sectors helps you connect the dots between what you see happening in the world and where you might want to put your money. And once you know which sectors are likely to benefit from the current environment, you're one step closer to building a smart, intentional portfolio.
Yes. Beautiful. All right. We've zoomed way out, looked at the economy, narrowed in on the sectors that make sense, and now it's time to talk about the last step, choosing a specific company to invest in.
Let's say we figured out that tech makes the most sense right now then. So how do I know which tech company to pick?
Yeah, so this is where stock research comes in. And again, we have an episode for this. This is a puzzle piece, so if you haven't listened to those, it will behoove you to. But the good news is, if you've already done the top-down work, you've cut through a ton of noise. You're no longer trying to pick a stock out of thousands. You're looking for just a few companies within a specific sector that fits the economic story. On your brokerage firm's website, this is where we're going to go to a stock screener now. We're going to screen and filter based on criteria. You can say, I want it to be in the S&P 500. I want it to be within the technology sector. That's what we're looking at now. And then we want to add some valuation. Just a quick little simple things to look at. And you can listen to our How to Analyze a Stock episode for more depth. One, revenue growth. Is the company growing its sales year over year? That tells me that they're making more money, being more profitable. We want that. Profitability. Are they actually making money or are they just burning cash? We can look at profit margins for that. Their competitive advantage. Do they have something unique like strong branding, patents, or industry leadership? I like to read analyst reports for that one. And again, those are free at your brokerage firm. And very important, valuation. Are you paying a fair price for this stock? Sometimes great companies are too expensive to be good investments right now. And this, of course, is the PE ratio, which we have talked a lot about.
Yes, episodes on that.
Yes.
And where are we finding all this stuff again?
Yeah, your brokerage firm. I love that we're asking that. And we need to tell our listeners where to find all this stuff. Most brokerage apps show this info under each stock. So look for financials, earnings, history, analyst opinions. But you can also keep it simple. Just start by asking yourself this. Do I understand what this company does? Is their business growing in this environment? Because you've started to understand said environment. Are they a leader in their space? If the answer is yes to all three, it might be worth researching more. And remember, you don't have to go all in with one stock. You can spread your investments across a few or even stick with a sector ETF while you're building confidence.
Yeah. So top down doesn't mean that you have to pick stocks. It just means that we could if we wanted to go deeper.
Exactly. Top down is a framework. Individual stock, it's just the last decision that you're going to make. So it's not the first. And the more practice that you have, the more natural it becomes.
Okay, that final step definitely brought everything together. So once we understand the economy, pick a sector that makes sense, and then look at a few strong companies in that group, then we're no longer guessing. You're actually building a case for what you want to invest in. And it's like putting together that puzzle that we always talk about. The company is the final piece, but it only fits if everything around it makes sense. And that gives us way more confidence when we hit that buy button as self-directed investors.
Yes. It's like one listener said in a review, we are taking you from novice to confident. And I love that. Like, we need to use that in all our marketing.
Yeah.
It's really great.
Confidence is everything when it comes to your money and how to spend it wisely, and not just listening to what people tell you to do. Go do your own research. Like, we've given you the tools and the information, everything you possibly need to take into consideration when it comes to that. And you can go, if someone tells you, oh, you should buy this stock, you can actually go do your own homework and decide if that person knows what they're talking about or not, and go back to them and be like, you know what, actually, I looked into that stock and this company doesn't seem like they're going to be doing too well. I don't know if I would invest in
yeah.
that one.
Or you could say, given the current environment, I actually don't think it fits right now.
Yeah.
I love that. Maybe we should do an episode on just how to put finance pros in their place and like things to say.
Yeah.
That would be fun.
Or just random people. I mean, everyone loves to act like they know what they're talking about because they've heard something on TV or from somewhere else, and then they go spreading it around. So just be aware of, or why is that person telling you to invest in something? Because they're heavily invested in it, and it like helps if more people start investing in it. Like maybe just consider
why. Yep.
Okay, well, speaking of reviews, we do have a new review to share from our podcast Wonderland of reviews, right?
Yes.
Okay. So this is, that's the name of the user, Wiz Wonderland. I thought that was a joke.
Yeah.
I was like, I'm not saying that.
I heard you. You're like, is she Taylor Swifting me
yeah,
now?
Yeah. Now I don't know. Now I'm paranoid.
I mean, every time I listen to Wonderland, I think of you.
I mean, I do love Alice in Wonderland and a Wonderland whimsical fantasy.
That's what the song's about.
So, yeah.
I understand.
I understand why you think of me.
Yeah.
Okay, so here's a review from Wiz Wonderland. Love the show. 5 stars. I love the teacher-student dialogue as it helps me understand key stock topics. Great show. Thank you. Thank you for reviewing us.
Don't you know what happens to curious minds? Now I'm gonna. We are
Now you're just trolling me.
I am. If you would love to tell us how you really feel, please leave us a review or a star rating. It does help us grow. It's the thing that gets us on the charts. So please and thank you.
And if you add in a Taylor Swift reference, Jess gets really giddily excited about it.
It makes me smile.
And please do share this podcast with everyone you know because it helps us grow.
Yes. And until next time, remember, when you build knowledge,
you break down barriers.
Remember, investing involves risk. There is always potential to lose money when investing in securities. MakeHer provides educational content and resources for informational purposes only. We are not registered financial advisors and do not provide personalized investment advice. Any information provided by MakeHer on our website or podcast is not intended to be a substitute for professional financial advice. MakeHer is not liable for any investment decisions made based on our content.